Hey, Tom here. Welcome to Patterns and Profits. This is our weekly live stream where we cut through the noise, separating headlines and memes from real market patterns you can actually trade. Each week, I'm going to break it down into three simple parts. Spotting opportunities, where we look at what's moving in the market and where real opportunities may be hiding. Creating alternative risk trades, where I walk you through different ways to structure trades, manage risk, and stay flexible no matter where the market's going. And as a bonus, I'm adding Money Calendar Monday, where I look to identify repeatable patterns that I'll be trading based on timing, probability, and structure. Finally, if you want to access everything we have to offer, articles, education, tools, and more, then become a member at patternsandprofits.com. It's absolutely free. All right, enough said. Let's get back to the live stream. Hey, good morning, good afternoon, good evening, everybody. Tom Gentile here, resident pattern trader in the house. It is Monday, March 30th, just after 12 o'clock. Glad to have you guys all hanging out with me. Going to focus on three things here in our session together today. I want to look at Q1. I want to look at the overall statistics, and I want to show you what we've been doing in Q1 and do a little bit of a comparison and really kind of a how are we doing this? What are we doing in Q1? Because you're going to see some distinct differences from the buy and hold, from the day trader, from the meme trader, and from the pattern trader. All right, we'll talk about that. I want to get into April money calendar. I know April is just around the corner. We're just 2 days from April, but I want to talk about the April money calendar. I want to show you the calendar at its entirety, and I want to show you what it is that we are looking at coming into this weekend. And finally, so I haven't talked about this in quite a while because it's not often that I get on the short side of the market. But if you are on the short side of the market, or you're thinking about getting on the short side of the market, maybe you're looking for that TGI Fridays, or you're looking for that Applebee's that used to be on the corner. It's no longer there. And you're thinking, what's going on? The restaurant industry is imploding because of high costs, because of tariffs, because of high wages. And they're just, the restaurant chain that you and I maybe used to go to, it's not there anymore. And you're thinking maybe there might be a play on the holder of such companies, or maybe it's something else, whatever it may be. Puts or put spreads. I want to talk about puts. I want to talk about put spreads, how to create them. We're going to take a look at those as well, give you some clues on what I use those for when I do use those. So that's what I want to do with you folks. Hey, questions, comments, etc. If you're live with me, put them in the Q&A or right there in the text box, and we'll jump in and out and take a look at those. A lot to cover here, so let's go ahead and get started here, shall we? All right, so looking at Q1 of 2026, this is one where a lot of folks buy and hold at the top of the list would rather forget. It, to me, feels like, it feels almost exactly like last year, where we fell into March, all right? So if that's the case, are we going to hit bottom here now that April is in like it happened last year? I think 1 year doesn't create a pattern, but I want to go through what's happened so far in Q1 and what I see going forward. So let's first talk about the index markets. So on the screen here, I've got really a snapshot as we head into today of where U.S. index markets have been for the better part of the quarter. So if you look here, you've got, I'll put some notables. I'll talk about some notables. There's SPY down 7%. All right. Here's QQQ down 8.42% for the quarter. Here's DIA, which is the Dow Jones Industrial Average ETF. That's down a little more than 6% for the quarter. You might say, but Tom, there's some green on the screen. Well, yeah, all the inverse stuff, all the stuff that goes up when the markets go down. Yeah, that's green. Look at the leverage, though. The leverage, and this is why I don't like these leveraged securities, because not only do they fall harder, but of course, all of these have one thing in common, and that is that they have a management fee. Okay, you got to keep that in mind. I think some of the best ones long term. I like SPY, I like QQQ, I like DIA, but a lot of the stuff on the right hand side, I'm not crazy about, and you can see why as as much of it falls harder as the markets fall. Let's move on to notable stocks. Take a look at Microsoft up there, down 26% for the quarter. All right. Apple down 8.48% for the quarter. Nvidia down double digits, 10%. Google down 12 3/4. Amazon down over 13.5. Tesla nearing 20%. Meta down 20%. It's, the Mag 7 is not where you want your money to be here in Q1. Let's move on. What about commodities? Well, it's been a mixed bag for commodities. You take a look here and you can see that, in the area, and I'm not going to get into leverage because I don't like these levered things like I've said before. But if you take a look at precious metals have been a mix. Platinum and silver down, palladium down, gold's been up slightly. Gold's right now, as of this morning, clocking in at 4.64% for GLD. The big winner has been crude oil, up 79.5% for Q1. We all know exactly why. But again, when you take a look at commodities, the majority of commodities are down because they're down against what? Get down against what's happening in the geopolitical world, down against what's happening in the Strait of Hormuz for oil. But most of these are down against oil. And then you got cryptocurrency, right, which has had a winter, a bad winter. Bitcoin's down an average of about 25%. And if you take a look at the ETFs, BITO down 25.41, IBIT 24.67, FBTC 24.61, GBTC 24.85. These are all mimicking Bitcoin quite a bit. And you got BitB and ARKB in there in that area as well. But for the most part, Bitcoin has suffered the most when you look at the assets themselves. So how are we doing so far this year? I mean, I've got alert services in Money Counter Pro. I've got Cash Flow Trader. I've got cryptos, commodities. Adding all those together, we've had 34 closed trades so far year to date, 26 winners, 8 losses. That's about a 76% win rate. And when you look inside, some of the stuff that's been doing absolutely terrible, which is Bitcoin and a lot of precious metals. I think gold's the only precious metal that I'm looking at that actually went higher, but it's fallen off here in the last couple of weeks. In our cryptos and commodities alert service, we do not have a single loser this year. Okay. How are we doing this? What are we doing different? Well, again, we're not day trading. We're not meme trading. We're not trading because I think something's going to go higher or I think something's going to go lower. No, we actually follow I like to call it the 3-legged stool approach to trading. Stool number 1 is to spot an opportunity. Now, what we do is we spot the opportunity. In the majority of what we do is seasonal. So I'm looking at seasonal opportunities. I'm using at least 10 years of data, sometimes more. And I'm looking for these patterns that occur in 90 to 100% of the time over the last 10 years. That's part of it. I use a tool called the Money Counter. You guys all know that. You're no stranger to it if you've been hanging out with me for even the last couple of weeks. I use the Money Counter. Is the Money Counter 100% going forward? No, it couldn't be. Otherwise, I'd be 90% or 100% accurate all the time. No, but and there's no guarantee that what I see in the past is going to work in the present or the future. All right. But when I look at the mess that is behind me here on the board, I will be a pattern trader. I will be a seasonal trader any day of the week. All right. And so that's one way of doing it. What about options? Okay. What about options? Well, that's where I go in and I look to create one of 2 option strategies. Either I look for a high profit strategy where I'm going to look to target a double or even a triple on the cost, or I'm looking at a high probability trade where I'm taking the historical probability of the Money Counter and I'm adding statistical probability on top of that, right? What do I need? What is the number one thing that's going to give me an edge in options? It's not the option price. It's not the expiration date. It's not the strike price. It's not the easy things that a lot of option traders come to the table with. And they go, oh, I'm going to trade options because it's cheaper than a stock. No, if that's what you're coming to the table with to trade options, turn around and run, right? But if you can understand that there's more than price, that there's more than time, that there is something called volatility or implied volatility, and if you can understand how to spot options that are cheap relative to their average vol and options that are expensive relative to their average vol, that's going to give you an edge in options. And that's what we do. All right. So step one is just spotting the opportunity. Step two is looking at the options and determining, is there an option strategy that makes sense? And then finally, and this is the part that you have to do, if you're going to be, if you have an attempt to be successful in trading, is you got to execute your plan. Execute your plan when it's right. Execute your plan when it's wrong. We've had a lot of right trades this year. We've had wrong trades too. I'll be the first to tell you, Microsoft came up as a buying opportunity for me. Look what Microsoft did. It fell 26% in Q1. Now, the silver lining to that is that with the trade we put on, we lost a lot less than the Microsoft stockholder, but it was a loss nonetheless. Again, I come to you and tell you I'm not 100%. Okay, I'm not 100%. I strive to be 100%. I always try to be 100%. But putting those three things together, spot the opportunity, create that alternative risk strategy, and execute the plan, that's how we put ourselves together and put ourselves in a position to be in the best position we can when it comes to the trade from beginning to end. Well, the Q numbers for 2026 are in. Dow's down 6%, S&P down 7%, NASDAQ down 8%, stocks like Google and Amazon down 12%, Tesla down 20%, and Microsoft down 24%, all for Q1. Q1's been a bloodbath for day traders, meme traders, and those who thought their favorite stock was going to go up. Well, I'm here to tell you it doesn't have to be that way, folks. So join me on Tuesday, April 7th at 4 p.m., just after the market closes, as I go through my spring cleaning workshop with seasonality. In just 1 hour, you're going to learn how to remove those dead weight trades that are keeping you down, how to clean up your watch list and sweep away the old stuff for some new things and identify unengaged capital. That means we're going to relocate our buying power with new opportunities in Q2 and much, much more. Just click the link on the QR code there on the screen, or you can check the links below for more information. I'll see you there. All right. Hey, we're back. And I want to put that link up on the screen for those of you that, maybe you're looking at your phones and you can't snap a QR code when you actually are watching this on your phone. So the link for my April 7th session is in the box below there. You can take a look at it right there in Patterns and Profits. I'm going to throw it up there one more time so you can check that out. So let's get into the next piece that I want to talk about, and that is April. So April showers bring us bulls. All right, what the heck does that mean? We've gone through a March that is very mimicking of last year. And if that's the case, if you take a look at April, the first week of April, we actually ended up bottoming. All right, we ended up bottoming during that time frame in April, and then we ran from there straight up, and then that ran into May, June, July, and you can see the chart of what ended up happening. But it all started in April. So when I look at April, and this chart of April, if I blow it up here for you, this is the month of the entire April money calendar. And what I'm doing is I'm looking at ETFs. So I'm looking at the top ETFs that are traded, and I have them displayed on the month. You see all that green on the screen? That is showing me the trades that have, anywhere from, I'm looking on this calendar here, and I see 92% on the bottom side, 91%, and 100% on the upside. So we're seeing, this isn't every ETF, folks. All right. This is only those ETFs that have either a 90 to 100% bullish or 90 to 100% bearish pattern over the last decade. As you can see by the green on the screen, the majority of what we're seeing here is showing up bullish. The vast majority is showing up bullish. So if we were to go in and look at just this week only, all right. So this week only, first of all, we have a 4-day week this week. We're going to be taking a market holiday on Good Friday. So let's focus on Monday, Tuesday, Wednesday, Thursday. And as you can see here, 83, 89, 92, and 90. As we get into April, we start to swing even more toward the side of the bulls when we're looking at ETFs. All right. So I talked a little bit about ETFs last week, and let me rewind on that because a lot of what we're seeing last week is the same thing coming into this week. So what we're seeing is this. The ETFs that are at the top of the list. The Qs are still up at the top. So is SPY. Then I see UPRO, TQQQ, and SSO. Guess what? Those are all indice-related ETFs. So when I see those, it just tells me that the markets last week, we only had 2 of these showing up on the list. Well, we had XLK too. But this week, we're seeing more and more ETFs moving over and becoming bullish as we end March and as we go into April. So if I were to just take a look at the top 2, which is what we did last week, we saw QQQ last week. We saw the going back to late last year, the lows in the Qs at 580 on the screen. We saw the highs of the Qs, which there was a double top. There was one at the end of October, and then it happened again near the end of January. We double topped up here around 640. And then we bottomed last week at around 580. And since then, we've wiggled a little bit sideways, but we still got a lot of this particular 50, 55-day pattern happening with QQQ, right? Bullish seasonality. So again, as we go into April and May, that is the big months for the NASDAQ 100, or in this case, the Invesco QQQ Trust. Same goes for SPY, although SPY isn't as strong. We've seen lows down here around, we saw a double bottom at 650 that got taken out last week, all right? We see tops that happen. We were forming that higher highs, and then we topped out at all-time highs back at the end of January, and that was just shy of 700 on SPY before the big downslot that took us from close to 700 all the way down into the low 6s. That was very close. I want to say probably about an 8-9% drawdown before we saw a little bit of a rebound here into last week. Where do we go from here? Again, we got the entire month of April and the entire month of May heading into June, where we see the bulk of this spring seasonality happening for SPY. All right. So, I discussed this when we looked at SPY and we looked at QQQ. There's a couple of ways that we could look at this, but these are indices, all right? And these indices are such that when you take a look at SPY, and QQQ, first of all, I'm a fan favorite of the Qs. I think it has a stronger seasonality pattern. I know it has a stronger looking technical pattern on the chart. And it's just a matter of, again, I've spotted the opportunity. What do? I want to create that alternative risk trade. So I'm going to look at calls on the Qs. I'm going to look at call spreads on the Qs, and I'm going to compare the two. Am I going to be looking at options that expire next week? No. Am I going to be looking at options that expire in April or May? No. I'm going to be looking for options that expire sometime after June the 9th, which is the end of the pattern that I'm looking at. Now, this is what I refer to as trading the haystack. The haystack is trading an ETF, which is a group of stocks. And you've got, for instance, in the NASDAQ 100, you have 100 stocks. In the S&P 500, you have 500 stocks. But I look at those and I'm putting them together to try to figure out, a way of maybe deleveraging myself more, a way of diversifying myself more. And that's what trading the haystack is all about. But there are better opportunities in single stocks than there are in haystacks. Haystacks cannot get you the 100% or 200% gain on the option strategies as fast as a single stock can, because a single stock is an alpha stock where ETFs are always going to be betas. They have many stocks in there and they're constantly fighting with each other. So single stocks on Tuesday, April 7th, I'm going to be holding a private event. And let me tell you what I'm going to be doing in there in my spring cleaning event. Part of my spring cleaning event is going to be identifying stocks in Q2 that fit that seasonality bill. And I'm not going to talk about QQQ. I'm not going to talk about SPY. I might refer to them, but I want to find a couple of stocks, single stocks, that have those capabilities of having the doubles or the triple returns when you match the right option price to it. So if you want to be part of that, then here's where I want you to go. I want you to click on that QR code that you see on the screen, or you can click the link that I put in the chat below, and that will bring up a registration page. All right. This is absolutely free to you, but it's not something I'm going to be live streaming. It is a closed event. I'm going to be on for about an hour, April 7th at 4 p.m. So from 4 to 5, I'm going to talk about what I call spring cleaning. Let's remove the dead weight from our trades. Let's talk about exiting positions that no longer fit the current seasonal cycle. Next, cleaning up the watch list. All right. We're going to sweep away stocks that are not flagging on the money counter. So I'm going to show you the stocks that you don't want to be following. Right. And then finally, I want to talk about stocks that I am following heading into Q2. I call those the hidden gems. No one else is going to spot them except me and you. And of course, those that follow the money calendar. All right. So this is all part of a Patterns and Profits spring cleaning event. Again, it will be Tuesday, April 7th at 4 p.m. And I hope to see you there. Hey, Tom here. Welcome to Patterns and Profits. This is our weekly live stream where we cut through the noise, separating headlines and memes from real market patterns you can actually trade. Each week, I'm going to break it down into 3 simple parts. Spotting opportunities, where we look at what's moving in the market and where real opportunities may be hiding. Creating alternative risk trades, where I walk you through different ways to structure trades, manage risk, and stay flexible no matter where the market's going. And as a bonus, I'm adding Money Calendar Monday, where I look to identify repeatable patterns that I'll be trading based on timing, probability, and structure. Finally, if you want to access everything we have to offer, articles, education, tools, and more, then become a member at patternsandprofits.com. It's absolutely free. All right, enough said. Let's get back to the live stream. All right, welcome back, everybody. I want to spend the last few minutes of our time together talking about puts and spreads and doing a comparison. And I'm going to really talk to those of you also like Roland, who's discussing how do I decide on a call or a put spread if you're at the money, or how far do you go out of the money for a trade. I'm going to show you exactly what I do there, Roland. So thank you very much for the question. I'm going to throw that one up there as I'm looking through the Q&A. Hey, hello to everybody out there that's coming from Oslo, Norway is in the house. Awesome. Always wanted to visit Norway. And I've got a few trips planned on my bucket list for this year, but I plan on getting out to Europe and doing something out there. I don't know if it's going to be later this year or early next year. But anyway, thank you for tuning in with us. Plano, Texas is here as well. Thank you, guys. And then there's a question, or really something that came up that has to do with some of our premium services. So we have something that we released recently called Money Calendar Pro Plus. That's a lot. Money Calendar Pro Plus. All right. What Pro Plus does is it elevates the Money Calendar Pro experience to allow you to have scanning right, to have scanning in Hub. So what we talk about is, let me just bring something up. I'll show you. I've got the Hub chart up because I'm going to be using it, but I'm going to go ahead and duplicate that. And I'm going to show you what Pro Plus users get the ability to do. So within the Hub platform, all right, what you'll do is you'll just go and log into hub.com. And once you log in, and I've got to throw my name and password in there, I'm going to log in. And what I'm going to do is I'm going to bring up the front page. And the front page is going to be the dashboard with themes, ideas, and members. But over here on the left-hand side, what you're going to do is you're going to come to the left-hand side. You're going to see something that down at the bottom says Money Counter. So Pro Plus members have access to this link. And when you click on Money Counter, it's going to bring up the Money Counter for March, for April, for May, et cetera, et cetera. And you're going to be able to go through, just like I do as a pattern trader, and click on a specified day and bring up all of those patterns. And you're going to be able to go over here and manipulate those patterns to bring up just the ones that you're interested in. And from there, you can now do more research and you can see just how those patterns are looking on their 10-year basis, both bullish and bearish opportunities. All right. So that is available to our Money Counter Pro Plus subscribers. And if you have any questions on any of the premium services that we offer, member support at gulfportanalytics.com is the place to go. And Jay is in the house. Jay, if you could just throw that up there, give everybody the email address if they have questions or comments on any of our premium services. And I want to now get to the final part of what I want to cover with everybody here. So let's talk about puts and put spreads. So ever been in a situation where you see something that is showing up on a pattern, on a bearish pattern, and you're not quite sure how to handle it? In this particular session, I want to talk about puts and I want to talk about put spreads. I want to do a comparison of the two for you. So let's go ahead and get started. The basics, all right? Buying put options. Let's talk about put options first. Well, they are bearish. They are a bearish directional strategy. It is literally as simple as buying a call option, all right? They are for rewards. They happen to the downside. Risks are if the market goes up, because if you're buying puts, you're expecting the stock to fall. So your risk is going to be if the stock stays sideways or the stock goes up. What we're doing is we are buying to open a put, and that gives us the right to sell a specified security or ETF at a specified date at a specified price, okay? That's all a put option is. It gives you the right to sell. And so think about this. If a stock is gone down, you can do a couple of things with it. Shorting it. You could short the stock. A lot of people can't short stocks because shorting stocks come with a high margin requirement. All right. And that short there, you got to have some capital if you're going to short a stock, because the risks against you are much higher than someone who buys a stock that has risks to the downside. So a short put risk graph, a conventional risk graph, is going to look like this. You know, this is your stock right here. It can go up, it can go down. If the stock goes down, puts go up in value. If the stock stays sideways or goes higher, puts will pretty much, you know, you risk what you put into the actual trade. Okay. So we have unlimited potential. We have limited risk with a put option. Here are the risks that I think that are out there. You have delta risk. That's where you have no stock price movement. If you buy a put that's at or out of the money and the price of the stock doesn't go anywhere, that's a risk to the put buyer. You have theta risk. That's where the price could go down, but the option could collapse faster than the stock going in your favor. That's called theta risk. And then finally, you have vega risk, and that's where, you know, a lot of us buy expensive options. These are where you buy options that are overpriced. Now, I'm going to give you an example of one that just right off the bat. A couple weeks ago, when oil spiked up and jumped up to 130 or 128 overnight, coming into that morning, there were people that were buying call options, but there were also some people buying puts. The problem with both of those groups, they overpaid for those options. So as you can see, oil has come back a little bit, but it's come back up, and it's actually exceeded those prices. But do you know that there are some call and put traders that lost money even when it went in their direction because they just overpaid for those options. Now, how do puts get profitable? Couple ways. Stock price goes down and the puts rise in value where the stock drops faster than what you paid for the put. And of course, you're going to see a rise before expiration. Now, option prices could get more expensive, meaning that the stock in question doesn't have to move, where you might see puts and calls get more expensive. It might be something like an upcoming earnings report, all right? So the puts would gain value even if the stock doesn't move. That's called an implied volatility spike. That's good for you. That's good for the put buyer, so long as you exit the trade before that volatility could turn around and revert. So let's construct a put option with TripAdvisor. So, TripAdvisor is coming up. It's not a fan favorite. It's actually seasonally bearish right now. And I thought what we do is take this as a case study, because I think this makes a great case study in so much that when you compare short stock to puts, you'll see that that the puts really win out, and I'll show you why. So in order to construct a put with the Hub platform, what I'm doing is I'm bringing up the chart in question. This is TripAdvisor, and you can see TripAdvisor has tripped on its own stock price and has gone from just below 20 down to just below 10 before coming back a little bit. So it's trading above $10 a share. And for whatever reason you might be looking at it, if you believe it's bearish, shorting this stock is it just doesn't make sense. It's already $10. How much lower can it go? You've got potentially it could go to zero. I don't think it's going to get there anytime soon, but I do think it could drift down. But what if something happens and it gaps the stock price up? Because I believe the volatility on this stock is to the upside, even though the pattern is down. So to me, the best way to take advantage of this is not shorting the stock. It's looking at options. And the first thing I can do is look at a put option. So I've got put options on here out to May 15th. So again, buying a put means that I'm looking at the right to sell. Here's the $10 put, 75 by $1. Okay, so you might think, wow, that's cheap. But I mean, $1 represents 10%, roughly 10% of the price of the stock. So it would need to move at least 10% for you to break even, right? So this is the first thing I'm looking at. So to buy that put, I'm simply going to move my mouse over to the ask portion. I'm going to click on that, and it's going to put in the difference between the bid and the ask. So it's actually putting it mid price at $88. All right, $88 max risk and $911 max profit. In order to get that, it's got to go to zero. Let's bring up the risk curve. The risk curve is going to look like this, which shows me if the stock goes lower, the put gets more valuable. You can see that going on right here on the risk graph itself. So that is how to construct a put using Hub's database and using the Hub option platform. Now it's going to look like this. And what it really tells me is that, what does your system tell you if you want to buy puts? And does your put price allow for profits if you hit your target? So the break even on the Trip case study is $9. If you pay $1 for that put, the double is going to be $8. The stock's got to get to $8 because then the put will be worth $2 in value. So the next thing I want to do is compare that. I already know I like it better to short stock, but do I like it better than maybe a put spread? I want you to kind of keep some things in mind. You're talking about, 90 cents to $1 to buy the put. But what if we could buy a put spread that was very close as well? So what if we instead look at a put spread? What does a put spread do? It gives me the right to sell, and I'm obligated to buy. So what we're doing is we're buying the higher strike put, selling the lower strike put, and we're doing that for a lower risk, a lower cost, lower risk, and a better break even. So I want to construct a put spread using TripAdvisor. And now to do that, I can pop right over and utilize what I've got right now. So let me bring this up so everybody can see it. When going to the Hub option platform, if I want to construct a put spread, I could start with the put option I already have in so that I can compare it. And looking at TripAdvisor, if I were buying the May 15th, right, that May 15th $10 put, I'm going to blow this up so everybody can see it. I'm looking at that bid and offered at 75 cents to $1. Okay, this is a 46-day option. But if I want to see if I can make it, lower cost, lower risk, better break even, why not look at potentially selling the $9 put? So the $9 put right now is trading 40 cents by 60 cents. I want to click on the bid. And when I click on the bid, that changes everything, right? Let's talk about what it changes here. First of all, it's going to change the look of the risk graph. Now the risk graph has limited risk, upside risk, and it has limited downside reward. Well, what actually happened here? What happened was I took my buy to open 10 put that was mid-priced at 88 cents. You could sell to open the $9 put, same expiration, different strike, lower strike, same expiration, same number of strikes, long one, short one, but this one's mid-priced at 50 cents. So together, this takes an 88-cent trade, brings it down to 38 cents. Now what I've done is I now have a $38 risk, and I have a $62 maximum profit potential, and a maximum profit potential that might be quite good. Think about this. If I bought just the $10 put, if we get to 9, I'm just above break even, where all of a sudden the put spread trader has maximized their profit potential. As you can see right here, your maximum profit potential is more than double what you've risked on this particular trade. And I can see all of that right here. I've got the chart in front of me. I've got the option strategy right here in front of me. I've got the details of that strategy down here in the lower right-hand corner, and in the upper right-hand corner, I've got my risk graph, which shows me exactly where that option is theoretically the profit and loss are going to be relative to the price of the stock. All right. So there you go. And that's, to kind of summarize what we talked about with puts and put spreads, let me just share this with you. The put case study with TripAdvisor, again, I asked the same questions, folks. What does my system tell me, right? What does the system tell you? If it's telling you that TripAdvisor is not going down, or there's some reason why you don't see it going higher, then you don't take the trade. You don't even get to this point. But once you evaluate that opportunity, it's then comparing things, especially if it's directional. What's the put going to offer me? What's the put spread going to offer me in terms of cost, risk, and reward? And in this case, with the put spread, the break even is $9.62. Okay, the break even is $9.62. The double is $9.24. So it lends something to consider when you look at comparing puts to put spreads. All right. And with that ends another live stream session that I've had with all of you guys. I want to thank you all for being part of this. Come on back with me next week. I'm going to be shifting some gears next week with some of the stuff I'm doing. And of course, we've got that big Tuesday event as well. If you haven't checked that out, folks, or if you came in late, I got an event that's going to be going on Tuesday, April 7th at 4 p.m. If you're interested in being part of that event, then I would urge you to join me. Okay. I have a link in the screen. Let me put it on the screen there in the chat one more time. I'm going to put a QR code right at the top of the box, right up here. Look up here by my finger, right? Because up here by my finger, you're going to see a QR code come in. There it is. That is the QR code for my spring cleaning event. We're going to clean out stocks that we don't need in our portfolio. We're going to evaluate the stocks we don't want to get into, and we're going to look at a few that look really good in Q2. I call it my spring cleaning event. All right. Only happens once a year. and you get a free seat, but only if you register. Thanks for joining me, everyone. Have a great rest of your day. I'll see you here again, same time next week. Bye now.